Good afternoon, everyone, again, and welcome to the second half of the Future Generation Investment Forum. Okay, so to kick things off for the second half, I'd like to introduce our first presenter, Nicky Thomas, and I'm absolutely delighted that we're also welcoming a female fund manager to the stage as well, our one and only today. Unfortunately, we might change that for next time. But Nicky Thomas is from Magellan Asset Management, which is one of our FGG fund managers. And Nicky is the head of research and is a portfolio manager. She joined Magellan in 2007. Nicky tells me that in her spare time, she helps manage her plant nursery on the south coast of New South Wales, and she also rides a 650cc motorbike as well. So please welcome Nicky to the stage.
Hello everybody, it's lovely to be here. I'm very glad to be a female too. There we go. Okay, so before I start, firstly, if I could just say thank you to Louise and her team very much for including Magellan as part of the FGG investment portfolio. I'm going to talk about a company that you've probably never heard of, so stick with it. Before I start though, I want to make one important point. Magellan runs a portfolio of stocks. This happens to be our largest investment in that portfolio, and our mission for people out there is to minimise the risk of a permanent capital loss, so preserve your capital and also make a return. And we run a portfolio of stocks to do that. So it's very important to think about this in the context of a portfolio, not just as a single stock. So of course Apple is the largest company in the world, and as the slide will tell you, this is pretty much about the iPhone. So about 75% of the gross profits of this business come from the iPhone, and another 12% come from services. So services, all those things you do on your phone, using iTunes, Apple Music, the App Store and so forth. So they make money out of that as well, and of course if you're using Apple Pay, they're making money out of that as well. So that piece is growing rapidly and is a very important part of the puzzle in understanding this business. But I think the mistake most people make with Apple is they think of it as a hardware company. It looks like a hardware company, it sells Macs and phones and iPads, but actually it's a software company. It's the software piece that actually makes this business sing as an economic model. When you think about the software piece, you have to think about what it is that iPhones represent, and they're a smartphone. In the world today, there are 2.6 billion, 2.7 billion, in fact, smartphones out there in the marketplace. That's against a population of 7 billion people in the world, so there's still a lot of room for growth, but it's a lot of phones. Who operates? Who's the operating system inside those phones? Well, 98.5% of those phones are run by just two operating systems. One is Android, which is owned by Alphabet. They have about 80% market share. And almost all the rest is Apple's iOS. So it's the iOS operating system that is what is very important to understand when you think about why Apple is a valuable business. So you've got a smartphone in your pocket and you use it for just about everything. Who doesn't have a smartphone in their pocket? Okay, there's two hands. And when you're doing that, you're obviously very engaged with your smartphone, whether it's an Android operated or an Apple phone. Indeed, Apple phones have a user retention that is over 90%. I think it's about 95%. People love their iPhones. And they don't love them because it has a great camera compared to a Samsung Galaxy or because it collects their email beautifully. They love it because of the ecosystem that comes with being part of an Apple ecosystem. They love that when their phone gets dropped down the toilet and they can't retrieve it, they go to the store and they get a new one, they log in, and all of those apps they've already bought are already there. So the whole system works for you. You can talk to your friends on FaceTime. You've become part of an ecosystem, which means when you buy a new phone, you're effectively paying to be part of something. It becomes a subscription to an ecosystem. It's not just about the value of the phone, it's that you're staying a part of that. And you tend to stay a part of that. And if anything, more and more people are becoming part of that Apple ecosystem. If you look at what this company does in terms of sales of iPhones, what you see on the chart up here is the amount of sales to people who are actually part of the system already continues to grow dramatically. So replacement phones when you have to replace your iPhone every 2 or 3 years is an increasing part of the revenue streams for this business. And indeed, new phones, there's less and less new phones needing to be sold because you're increasingly just working on that 500 million installed base that Apple already has. So their ability to monetize that over time as they continue to sell phones to the existing user base and then have you use those phones and make money out of the use of those phones has become very, very persistent. This business has an incredible economic moat around it, and it has a revenue stream that you can see coming back to it year in, year out for many, many years to come. So you would think this would be a very expensive stock given it's got an 800 billion market cap. Well, indeed, if you pull out the fact that it has $135 billion of net cash even after you tax that, and you pull out the value of the services piece, which is over $200 billion worth of value, you're paying about 12 times for Apple today. 12 times. So we think this is astonishingly good value. The biggest problem you people have is when would you sell this stock? And so I'm going to give you one other stock tip here today. I can't come back and tell you when it's the right time to sell it, but I know people who do know when to sell it. And if you buy MGE, which is the Magellan Global Fund, which owns Apple and a lot of other business like this, we'll do that work for you. Thank you very much.
Thank you, Nicky. I am one of those Apple addicts myself, and she did mention iPhones and toilets, and I actually did that last Monday. I actually dropped my iPhone down the toilet and I was in the worst mood for about 24 hours, but Sam, who works for Jeff, got me that new phone and everything was in order and my life just recovered like that. But I was quite depressed and wasn't very productive on Tuesday, I think it was, when I got back to work. So thank you very much, Nicky. Lovely to have you on board with us, and also thanks to Magellan for the fantastic work that you do for FGG. Now, our second presenter this afternoon in the second half is David Prescott. And David Prescott is one of our FGX fund managers. He's based in Adelaide, and David is the founding director of Lanyon Asset Management, a value-oriented equity fund manager which was established in 2009. Perhaps the only thing that Dave loves as much as finding a good value investment, and his family of course, is seeing his beloved Port Adelaide AFL team winning a game of footy. And I'm glad to see that Port Adelaide whipped the Gold Coast Suns in Shanghai on Sunday, which of course created history by being the first AFL game for competition points that was held outside of Australia and New Zealand. So please welcome Dave to the stage now. Thanks, Dave.
Hi everyone, and thank you Louise and Jeff for the opportunity to be part of Future Generation. It is an enormous privilege, and to be involved even in a small way with the enormous contributions you're making to your charity partners. So today I wanted to talk about the most significant shift that has occurred in the Australian print industry for over 2 decades, specifically an event that occurred in the last few months. That event was the consolidation of the Australian catalogue printing industry to just 2 players, the formation of a duopoly. We think that will lead to the delivery of much improved returns for the sector. Over the last 10 years, there's been significant structural change in the Australian print industry, with all players being impacted by the substitution of physical print to distribution of content through digital mediums, like the Apple iPhone or a smartphone or other smartphones, emails and tablets. Catalogues, however, have been an incredibly resilient component of the Australian print landscape. Despite the broad reduction in printed volume that has occurred widely in Australia across multiple publications, we continue to print over 7 billion catalogues a year here in Australia. These are the catalogues that fall out of your weekend newspaper or are stuffed in your letterbox when you come home every single day. They are a staple part of a retailer's advertising spend, and, to put that another way, we print over 130 million catalogues every single week, and this number is still growing modestly. Over the last 5 years, as the broader print industry has suffered from declining print volumes, the resultant excess printing capacity has manifested itself in intensive competition, declining pricing and a savage reduction in industry profitability. Let me put some colour around that because we think it's important. Over the last 5 years, we estimate that the average print pricing has fallen 25%, from around $1,900 a tonne to around $1,400 a tonne. And as a result, the catalogue printing industry profit pool has halved from about $250 million down to about $120 million. This reduction in profits is due almost solely to the deteriorating price environment, as catalogue volumes have been broadly stable over that period. Last year, there were two important and significant developments. ASX-listed P&P Limited, which is Australia's largest and most efficient printer, was cleared by the ACCC to merge with its major competitor and the second largest player in the industry. Around that same time, another ASX-listed company, the IVE Group, orchestrated a merger between the third and fourth largest player. What was a fiercely competitive and dysfunctional market has now formed a duopoly. So we all know that buying shares in companies that operate in functional duopoly industries can often lead to spectacular investment outcomes. Where you have limited price-based competition and an orderly environment, it can drive strong shareholder returns. In Australia, you'll remember the returns that have been generated from Woolworths and Coles over many years, or Lion, Nathan and Foster's are two classic examples. In isolation, a duopoly market environment doesn't guarantee success or a ticket to riches, but a rational, orderly and well-performing duopoly is certainly a very good place to start. To put it another way, the current industry structure is a darn sight better than the brutal price-based competition that has decimated industry margins over the last 5 years. Over the next few years, we expect a rational environment between IVE Group and P&P, an orderly pricing environment and a gradual restoration of the industry profit pool. Remember, only 5 years ago pricing was 25% higher and the industry profit pool was 200% higher. We feel the best place to invest in this industry is through P&P. It's Australia's largest, best capitalised and, despite popular perception, Australia's most efficient printer. We don't invest in IVE Group at Lanyon, given our concerns about management succession and their highly leveraged balance sheet. Remarkably, despite being the market leader with a significantly stronger balance sheet, P&P currently trades at half the valuation multiples of IVE. At Lanyon, we started buying P&P 4 years ago when the price was 15 cents. This is the first time we've spoken publicly in detail about our investment, but since our initial purchase, the stock has subsequently gone up 4 times, and this is despite that challenging economic and industry dynamic. Whilst this is a very decent return, with an improved operating environment and a current valuation for P&P that still remains compelling, our view is that P&P investors can look forward to strong returns in the years ahead. So finally, let me walk you through those numbers and the valuation as we think they're compelling. At the current price of 64 cents, P&P's market cap is $320 million. Given the strong cash flows that will continue to be generated from this business, we expect the company, post the merger and all the subsequent integration one-off costs, will be debt-free by June next year, so within 12 months. The company is forecasting EBITDA in 2019 of $95 million, which I should point out assumes the maintenance of the current pricing environment and doesn't incorporate any recovery in pricing. We think that is an incredibly conservative position. A $100 improvement in average print pricing, you will recall from my earlier comments, would increase EBITDA by over 25%. So given the modest capital expenditures and working capital requirements and the company's enormous pool of tax losses, which will shield them from any cash tax for many years, we expect free cash flows for this business to be in excess of $80 million or over 17 cents a share. Given that expected debt-free balance sheet, the company is committed to returning this cash back to shareholders through dividends and share buybacks. And with the $60 million pool of franking credits, we expect the near-term fully franked dividends could be easily greater than 8.5 cents a share, implying a fully franked cash dividend yield on current prices in excess of 13%. We think P&P is flying under the radar and the stock market has failed to grasp the significance of these recent developments. Surprisingly, despite the announcement of the ACCC approval and a recent string of positive announcements demonstrating the very significant and tangible realisation of cost savings through press and site closures at PMP, this amounts to earnings upgrades, the shares have continued to drift lower. We think there is a significant price and value anomaly on offer here, and in our view, PMP shares are worth in excess of $1. We expect the price of PMP will move towards $1 over time, and investors will again take notice as these dividends start to flow. That implies a potential return at current prices in excess of 50%. Thanks.
Thank you very much, David, and also thanks to Lanyon for your support for FGX. And I know, as Jeff said, you were one of the fund managers that were keen on us doing this sort of event today. So thank you for giving us a nudge on that front as well. So next up we have Chris Dixon, and Chris is from Cooper Investors, who are a fund manager in both FGX and FGG, along with Paradise actually. They're the two fund managers that are actually in both of our companies. So we're incredibly grateful to Peter Cooper and to Amanda Perry and the team at Cooper's, including yourself, Chris, for your support for FGX and FGG. Chris joined Cooper Investors as Joint Portfolio Manager in November 2011, and as a member of the Global Equities team, he focuses on European and Japanese companies. Chris tells me he balances living in a very feminine household with 3 daughters, think frozen dolls and pink things everywhere, literally, with his blokey interests, which are motorbikes, so I'm sure you'll have fun talking to Nicky, and Hawthorn. So good to see Hawthorn have a win on Saturday as well. So please welcome Chris. Thank you.
Thanks, Louise, and good afternoon, ladies and gentlemen. So when Louise and Jeff asked me to do this, choose one stock out of a carefully constructed portfolio to talk about for just 5 minutes, it's actually quite difficult. It's like being asked to pick a favourite child. As Louise says, I've got 3 daughters and they all think they're the favourite, which of course they are. So I've chosen, after a bit of thought, Diasorin. Now, this is an Italian mid-cap diagnostics company. Why Diasorin? Well, we think it's got one of the best business models we've ever seen. It's also in an industry that has long-term secular growth, and it has an owner manager and owner chairman that have significant personal skin in the game. Now, this is an Italian hidden champion, okay? You can't visit them in Milan or Rome. They're not in the main Italian stock index. You can't go and see them at a London healthcare conference. No, you have to drive 2 hours west into the rural Piedmont countryside to visit these guys. So what do? They make and sell immunodiagnostic machines and test kits. Okay, now that sounds very complicated, so I'll try and simplify it for you. I'm sure everyone in this room has had their bloods taken, probably on many occasions, and when that little vial of blood gets sent away to the pathology lab, it gets separated out into a dozen or so smaller glass tubes called assays. Now, into those assays are pipetted chemical reagents. Each reagent is distinct, testing things like flu, vitamin C deficiency, HIV. Now, what's beautiful about this business isn't the machines that Diasorin sells that do the tests, but it's these reagents that go into them. This is a razor blade business model, okay? Once you've got the machine in the lab, you have to keep reordering these reagents from Diasorin. In fact, the CEO likens this business to an ATM in a lab. It's almost 100% recurring revenue. Now today, Diasorin has an installed base of around 7,000 of these ATMs and labs around the world, and that installed base is growing around 6 to 7% a year. The growth is coming from, firstly, new tests being added to the menu. So recently the company had approved the world's first automated Zika virus test. Secondly, it's emerging markets, the growth in the healthcare systems in places like China, new hospitals, new pathology labs. Diasorin's grown 30% per annum in China for the last 2 years. And thirdly, it's the miniaturization of the machines. So the current device is around the size of a piano. The next generation device will be half the size and fit on a bench top, which means that they'll be able to market it to the 50,000 or so smaller physician labs worldwide. And if they can get the current level of market share with the new device, that actually doubles the installed base. So a very, very simple and cash-generative business model, an exciting growing industry, but you know what really gets our juices flowing at Cooper Investors is culture. Now, I've been to visit Diasorin 3 times, most recently in March, and I can tell you this company has a special culture. It's been based near the town of Salujah for the past 30 years, and it employs multiple generations of the townsfolk. You know, you walk around the grounds with the CEO, Carlo Rosa, you can really feel the passion he's got for this business. He did a management buyout in 2001. He couldn't afford to do it himself, so he enlisted the help of a fellow Turinese by the name of Gustavo De Negri, who had just sold his stake in Piaggio, a company he would better known for making scooters. But Gustavo is, like Carlo, actually a biochemist. Today, these guys have taken a company from 100 million in revenue in 2001 to 600 million today. They've multiplied net profit by 5 times and delivered 600% total shareholder return. Today, Gustavo owns around 44% of the company, and Carlo owns around another 10% and has never sold a single share. So with these guys running the show, there's no debt on the balance sheet, by the way. We have very strong confidence in them continuing to focus on this big growth opportunity they have, remaining focused and disciplined on capital allocation. And we think this company could be worth around 90 euros a share by 2020 versus 70 today, which, including dividends, implies around 10% shareholder return growth per annum. And the final little juicy piece in this story, if and when they decide to sell the business, well, last year German Merck paid 20 times EBITDA for Sigma Aldrich, which gives you some idea what people will pay for a good reagents business. I think that's all my time, so I'll thank you for yours, and good afternoon.
Thank you very much, Chris, and I wouldn't mind going along with you on your next visit to Diasorin. Fascinating. I like that one, so thank you. A little bit different too. Like the simplicity of the slide too. Very good. I've got a special clap over there from someone. Okay, well, next up, join with me in welcoming Adrian Warner. Adrian is the Managing Director and Chief Investment Officer of Avenir Capital, which is one of our fund managers for FGG. Adrian founded Avenir in 2011. Adrian is an avid cyclist, and there's a bit of a theme going on here. I think we've got quite a few cyclists in the funds management industry. I know Jeff is an avid cyclist, but you've certainly heard there's certainly some AFL obsessive fans as well. So please welcome Adrian. Thank you.
Thanks, Louise, and it's a pleasure to be here and a pleasure to be part of the Future Generation investment family. The company I'll talk about today is Nexstar. And Nexstar is a US local broadcast affiliate. So they take primetime TV shows such as The Big Bang Theory and 60 Minutes from the big 4 US broadcasters and package it up with local content, including local news, sports and weather, and broadcast it from 179 local stations they own across the country. Their content is distributed primarily via the cable companies through which Americans access TV. We think Nexstar is an interesting investment opportunity because investors are more fearful of certain things than we think they should be, and they don't fully understand some of the positive aspects of this investment story. So what are they scared of? Firstly, they're scared that the rise of digital advertising and streaming services such as Netflix and Amazon Prime will cause TV advertising revenue to dry up, reducing profitability. The data shows, however, that unlike newspaper and magazine advertising, TV advertising revenue has actually grown as a percentage of total advertising spend, which is in itself growing. So we think Nexstar's traditional advertising revenue is a lot more robust than people think. The second thing investors are scared of is that cable TV is going to suffer reduced subscriber numbers over time, also because of streaming media. In response to this pressure, the cable TV industry is offering so-called skinny bundles, where they offer packages of fewer channels at a much lower cost. And we've found that even in the skinniest bundles of only 20 channels, you always find the 4 local TV stations because people want them. So now you're only competing against 16 other channels instead of 400. So the trend towards skinny bundles actually increases the relative importance and the competitive position of the local channels. Even better, many of the streaming services, such as Hulu and Amazon Prime and Apple TV, are actually adding the local TV stations to their streaming services as they recognise the persistent demand for these local stations from their customers. Another very positive aspect of the business that we think people don't fully value is its relatively new and high-quality revenue stream. About 10 years ago, the CEO of Nexstar realised that the cable companies were not paying anything for the content provided by Nexstar and other local TV providers, despite paying everybody else for their content. So Nexstar started demanding that they get paid for their content, and they have been getting paid. It's an entirely new revenue stream that has grown over 10 years to now make up almost 50% of total revenue. It's recurring, non-cyclical revenue, so it's even higher quality than their traditional advertising revenue, and it's going to experience double-digit growth for the next 5 to 10 years, as even now the local broadcast channels still only make up 10% of the content cost paid by the cable companies, while making up 40% of the viewing time of their customers. So there's a long way to go for the Nexstars of the world to get paid their fair share. So you're all sensible investors, so I know you're all thinking, what about the price? Well, Nexstar acquired another company at the beginning of this year for a combination of shares in cash. So it's now we see it as a private equity style deal in the public markets or a public LBO. And the company is absolutely gushing cash. For every $1 of revenue, they generate over 20 cents of free cash flow. That's cash flow available to shareholders after expenses, taxes, capital expenditure, after everything. Now, the company's making about $12 per share of free cash flow per year, and it's currently trading at about $60 per share. So if you buy Nexstar today, you're earning a 20% return on your capital. And just as a comparison, the S&P 500 today is trading at something like a 4% free cash flow yield. So if we split the difference and value this company at a 10% free cash flow yield or 10 times free cash flow, Nexstar is worth around $120 per share, which is a double from today's price. So we think people are overly focused on certain aspects of the Nexstar story and don't place enough value on a lot of these very positive aspects of the story. It's generating huge amounts of cash. All of this we see as being available to us at half price. And since we submitted the slide, the share price has actually fallen a couple of dollars since we put the slide up. So how wonderful for all of you to be able to buy this even cheaper now. That's the Nexstar story. Thank you.
Many thanks, Adrian, for that great presentation. So now we're coming to near the end. So I think we've got 2 to go. So next up we have Michael or Mike Dyer, and Mike is from Neuberger Berman. Special thanks to Mike because he's travelled from Hong Kong, where he's based. So hats off to him for making the special trip. Mike is Senior Vice President, Client Portfolio Manager for Equities and Alternatives at Neuberger Berman, who are one of our fund managers for FGG. Mike is into Thai boxing and CrossFit. He grew up in London and he moved to Hong Kong 2 years ago. He tells me he's got limited knowledge of Australian sports, but he did try and watch an AFL game once at the MCG. He enjoyed the pies, but he couldn't quite work out what was going on the field. So please welcome Mike to present his stocks. Thank you.
Thanks very much. It's a pleasure to be here. I was going to present 2 stocks from Neuberger's wide repertoire of holdings, but I think in the brevity of time, I'm just going to focus on one because there's quite a lot to say. And we all know the story of the ugly duckling. And what I'm going to talk about today is a stock which this time last year was an ugly duckling. I'm going to talk about Whole Foods. Now, Whole Foods, for those of you who aren't familiar with it, is a US grocery chain, an upmarket grocery chain. Fresh food, organic food. It's expanded rapidly in the last 10 years in the sort of vanguard of the healthy living, food integrity boom that's come through, particularly America, but more globally. But this time last year, everyone hated this stock. I mean, analysts hated it, hedge funds hated it, the press hated it, the market hated it. Had 15% short interest, only 4 out of 28 analysts had anything interesting to say about it. Its stock price had fallen from 65 bucks in October 2013 to about 28 bucks this time last year. But we liked it. Not only did we like it, but we bought it. And we made it biggest position in one of the portfolios that we run. Where's Whole Foods today? Today, it tags itself as America's healthiest grocery store. It has 464 stores in 3 countries. It employs 87,000 people, serving 30 million customers, generating just under 16 billion in revenue, and a market capitalization of about 11.7 billion. But there's a problem. America's healthiest grocery store is sick, or it was sick. The problem with Whole Foods is it expanded too quickly. It fell into the lovely position of being in a secular growth story without a management team who really understood Retail 101. So what you've had in the last 3 to 4 years is you've had falling same-store sales. You've had increased competition from the traditional supermarkets in the US. You've seen the management be reluctant or sort of insipid in initiating change in response to this. But sometimes, as the analyst who covers this stock said to me, sometimes things are so bad that they're good. When you stripped away all the negativity around the stock this time last year and you looked at the model that Whole Foods really had, you found a company that had, if not the best brand recognition out there, an exceptionally loyal customer base, and it had simply never done the basics of retailing. And when I say never done the basics of retailing, it had grown through a series of smaller acquisitions. It didn't have a unified point-of-sale technology. Can you imagine being a grocery chain without a unified point-of-sale technology? You can't change prices very quickly. You can't run a customer affinity program. So you've got these loyal customers, but you can't monetize it to the most efficient level because you can't run a loyalty program. It had opened stores without really thinking about the impact on its existing stores. It had been pretty much a growth at all costs measure. Interestingly, the shareholder base had shifted from being growth investors to value investors, and this stock was really in the doldrums. But as I said, we liked it. We thought it could be fixed. So at Neuberger, we characterize ourselves as active rather than activist investors. So in September last year, behind closed doors, we wrote to the management and we outlined the points that we'd like to see changed. A change in governance, a change in operating performance, operating measures to create in performance, and a readdressment of thinking about some strategic alternatives for the business. That was September last year. We've seen some changes. So we've seen a replacement. They had a co-CEO structure, which was kind of inefficient and very expensive. We've seen the CFO retire and be replaced. We've seen the right noises about engaging on understanding their customer base better, instigating a unified technology platform, launching an affinity program. Started to see progress. And at the beginning of April this year, a hedge fund called Jana Partners, we own about 3% of the company. Jana Partners came in and bought 8%. They'd seen pretty much the same thing as us. Now, Jana are a much more aggressive activist investor. They went public straight away with a 13D filing and said, we want to engage management to talk about capital allocation, corporate governance, and potential strategic alternatives to the business model for Whole Foods. Stock popped 30%. Since then, just last week, and this is why I switched from talking about 2 stocks to 1 stock, because there's a lot more to say. Just last week, at Whole Foods' second quarter earnings announcement, they talked about changing their strategic initiatives for the year. So they changed their 2020 guidance and their 2020 business plan. They replaced 5 members of the board. That's quite a lot. You know, turnover of 5 people in the board is pretty high. So they replaced 5 members of the board with people with better retail experience, and they initiated an increased dividend and an increased share buyback. We still think there's more to go in this stock. This stock, in our opinion, is now on a dual path. It will either be fixed by the current management, or it will be fixed by some kind of strategic alternative, i.e. it will be taken out by a purchaser. Now, when Jana got involved, they were offered 2 seats on the board with a standstill agreement. So what that basically means is you can have 2 people on the board, but you won't cause us any more trouble. They declined that. And we take that as a sign that they think that there's a purchaser out there if the management don't get their house in order themselves. So in short, Whole Foods has a great business model, a great business brand penetration with a hugely profitable demographic, this sort of middle to upper middle income American consumer. Even with a small amount of change in macro, i.e. a little bit of return in food inflation, they're going to see their top line increase. But there's an immense amount of very basic retail stuff they can do behind the scenes to create increased earnings in this stock. So I just wanted to focus on one stock today and talk about Whole Foods. This is, as we show on the slide, we've been quoted in the Wall Street Journal, the New York Times. We've been on Bloomberg, we've been on CNN talking about this stock, and Charles Cantor, who's the lead manager for the portfolios in, is well versed on this. We don't see ourselves as agitators for change. We work with management rather than against them, but we do see this as an opportunity where there is something very tangible that a company can produce to create real value. So right now this is trading in the mid to late 30s, sort of $37, $38. We see at the very least $45, $46 for this stock, potentially more over the long run. So we're getting very excited about what we considered was a broken growth story. So when I talked about ugly duckling last year, we're not quite yet bloomed into the swan, but we're getting there. So thank you very much.
Thanks very much, Mike. And I'm a bit of a fan of Whole Foods. I mean, when I'm in New York, I actually stay somewhere that's right next door to one, so I'm always in there. So thank you, and thanks for making the trip, especially from Hong Kong as well. We very much appreciate that. So to round things out this afternoon, I'd like to welcome Chris Stott to the stage. And Chris is the Chief Investment Officer and Portfolio Manager for Wilson Asset Management. So for those of you that are Wilson or Asset Management or WAM shareholders, you'll be very familiar with Chris, and he's been up here this morning with the WAM shareholder update presentation. Chris has more than 14 years experience in the funds management industry. He's an avid AFL fan himself, particularly the Swans. And his little story, which is quite fun, is that he once kicked for goal at Etihad Stadium in Melbourne, hitting the post. So it was a kicking competition at half-time at an Essendon game when he was 22. And I must say that Chris has certainly been kicking plenty of goals since he's joined WAM. So fantastic to have you here, Chris, and welcome. Thank you.
Thanks very much, Louise, and thank you for including me on such a wonderful day, and it's a privilege to be a part of such a great event. So thanks to Louise and Jeff for the invitation. It's very often as fund managers and as analysts, we get trained to invest against the pack, never run with the herd, always go against the tide. And that's some advice that was sort of instilled into me as an investor years ago, and all of the team at Wilson Asset Management, and it sticks with me today. So the company I've got to talk about today is a microcap. It's listed here on the ASX. It's got a market cap of around $200 million. It's cheap. It's on a PE of 13 times, growing at 10%. It gives you a return on equity of 30%, and it's going to generate anywhere from $10 to $30 million of free cash flow per annum over the next few years. So all the numbers stack up. The company that I'm here to talk today about is Reckon. Now, Reckon, for those of you who don't know, a bit of history on Reckon, they are predominantly an accounting software provider. They listed in July of 1999. They have been a well-run business for many, many years. Their historical relationship was with a company called Intuit. in the US who own the QuickBooks accounting software, who gave the license to Reckon many years ago to sell the QuickBooks software in the Australian market. Now, that went very well for Reckon over many, many years, and then Intuit around in 2012 decided that they'd bring that license back in-house. They decided that they wanted to sell into the Australian market themselves and go direct with their QuickBooks Online software. So that was a significant moment in time for the company Reckon and for its shareholders and for the investors alike. And what you've seen since then is the company has really struggled to an extent to really get any traction in the accounting software market. What they've done is they're trying to go it alone. They've created this own product called Reckon One, which is their own piece of accounting software that they're spending tens of millions of dollars on a year to really drive and create a piece of market share in the Australian market in that cloud offering. Now, for accountants out there who use software, there's a massive shift out there at the moment to what we call cloud software. Historically, you've walked into, say, a Harvey Norman or an Officeworks, you've bought your CD in MYOB or in QuickBooks, and you've done your accounting on what they call the desktop. That's now shifting from the desktop more to the cloud, where companies like Xero and MYOB, to an extent, have all got cloud offerings now these days and are the market leaders in this particular segment. Reckon, however, as we said, are continuing to invest in their product, trying to carve out a piece of market share in this very competitive cloud space market, which generates very, very high returns over time. So that's the Reckon One product. The key message which I'd like to leave with you today on Reckon is that they've got a second part to the business, another piece of software, practice management software called APS. And that's used by mostly professional firms, companies like Pitcher Partners and the like, who use that internally really as a database to help manage their clients and a more efficient way to do business effectively. That APS piece of software is the most underappreciated asset within Reckon. In our opinion, the Reckon share price today is $165. We think that the APS business by itself, which generates around 50% of the earnings, can be worth around $2 per share, so more than what the company's share price is valued at on the ASX today. So we think that over time, as people continue to grasp and get a hold of the inherent value in that APS business, that will continue to drive the share price of Reckon higher. We think that you're basically getting the rest of Reckon for free outside of that APS product. So where to from here for Reckon? Back in late of 2015, the company embarked on a sale process, a very public sale process, where there were press reports around the company being for sale. And it came through the press in various articles over a few months there back in late of 2015, where it was touted to be that the whole business was for sale. Macquarie Bank ran the process. It was touted, according to press reports, that there was only one bidder for the company, an unsuccessful bidder, obviously, with Reckon continuing to trade on the ASX today. So this one is a classic sum of the parts breakup scenario, in our opinion, where you've got the business division, as they call it, which is the Reckon One accounting software, and the old Intuit code, the old 100,000 subscribers which continue to use that particular piece of software, which is also a valuable asset to someone else. You've got the APS product, which I've spoken about, which is obviously a much higher, it's worth well north of the current share price over time. So remains to be seen which strategic path Reckon take from here, given that they've had mixed success so far in terms of investing in their cloud offering, being Reckon One. So we think that Reckon is incredibly undervalued. We value it well north of $2 a share. Our interests are aligned. We are, as investors at Wilson Asset Management, we own, full disclosure, we own almost 10% of the company. We're right standing next to the CEO, Clive Raby, who owns just under 10% of the company as well. So we think our interests are very much aligned, and we think as the market continues to appreciate this undiscovered gem, and as our founder at Wilson Asset Management, Jeff Wilson, calls them, we like to find these companies that start as ugly ducklings and turn into beautiful swans. And we think Reckon is one of those particular investment opportunities, and to us it's quite compelling at the moment. So thank you very much.
Thank you very much, Chris, and that was a bit of a gem to finish on, so we very much appreciate that. And also, I must do a special shout out to Jeff Kate Thorley, the CEO of WAM, and Chris as well, because the support that WAM provides for the future generation companies is quite extraordinary. They're really the backbone support behind the scenes that makes a lot of it happen, or most of it happen, so thank you. Before I introduce Belinda Hutchinson, who's the chairman of FGG, to do a wrap and some thank yous, I just want to let you know that we will be sending you an evaluation survey. We really want to hear what you think of this afternoon. Please be brutally honest with your surveys, and if you're more than welcome to email me with any suggestions as well at louise@futuregeninvest.com.au. But just by a quick show of hands, if we did this event again next year, would you come? Okay, that's pretty good. And would you recommend it to a friend or friends? It's good as well. I think we're going to look at doing an event in Melbourne, this same event in Melbourne in November, so please make sure you spread the word to any friends or work colleagues or family in Melbourne as well. I really want to thank the presenting fund managers, for their support for the future generation companies and for being here this afternoon as well. And following this, Jeff Wilson and I will present the latest shareholder update presentation on FGX and FGG. It's due to start at 3:30. We might even see if we can get that started a little bit early if possible. But that's where you'll hear a very detailed report on the performance in particular of what's happening with both companies. Now I'd like to introduce Belinda Hutchinson, who's the chairman of Future Generation Global Investment Company, and to do a wrap and to do some thank yous as well. Thanks, Belinda.
Thanks, Louise, and what a fantastic afternoon. Speed dating with fund managers probably doesn't sound that sexy, but I actually found it really, really exciting, and I thought they did an absolutely extraordinary job. Every one of them, I think, demonstrated so clearly why we, FGG and FGX, are so fortunate to have them as the fund managers who actually act on behalf of our shareholders. They had some great insights. As you can tell, the depth of analysis that they have done on each of the individual stocks that they showed us applies across their portfolio. And I'm incredibly grateful to them, and I know that my board of directors, I know my shareholders are incredibly grateful for them for coming along today. And I'd also like to thank all of the fund managers who support Future Generation Global and Future Generation Investments. They really are doing something very, very special for us in terms of providing us with an opportunity to be a dual-purpose listed investment company. And in terms of FGX, being able to help kids who are really at risk, and for those who are shareholders in FGG, we're able to support those young people and children who suffer from mental health issues. And the numbers, when you see them, are absolutely distressing, but we can really make a difference because we are giving away millions of dollars now a year because of the fund managers' generosity in terms of giving up their management and performance fees. So I really, really would like to have a round of applause for our fund managers, not only those here today. I also have to say a couple of extra thank yous. Now, Louise has already thanked Kate and Chris and Jeff, but I also have to thank Louise. Louise has put together with another team of people this afternoon's event, and I know, and I think all of those who've been involved in putting together AGMs, investment forums, conferences, know how much work goes into something like this. This has taken 6 months to organise, and Louise, you have done a stellar job, absolutely stellar, and I do have to just remind myself who else was involved. James McNamara, Alexandra Hopper, Natalia Mizwa and Alison Shave have been absolutely fantastic in getting this thing done today, and I just think you all deserve a round of applause, so thank you so much. And I think it's just fabulous that we've had close to 800 people here today. How brilliant is that? So please, as Louise said, spread the word about the investment forum. I think it's a great format. And we do have our AGMs for FGX and FGG to follow. Please stay. We'd love to tell you a bit about what we're doing, and thanks again for attending.